Yeah, good evening. Uh, I'm sure, okay, in last couple of years, rather more than that, 3, 4 years, um, including the current time, whatever you open, right? Even the new channels, not talking about the business channels, the normal, regular political news channels, the social networking places, starting from YouTube, Instagram, Facebook, X, and whatever, right? So stock market has become a very household subject. I mean, wherever you go these days, right? You're taking some food in a restaurant, you're sitting in a plane, you're sitting in a train. There is some discussion about the market. So market has got the attention of the general public. And of course, what exactly has caught that attention? It's certain excitement, right? So you will see this, you'll hear the stories when somebody has made crores of rupees, right? Then there's a pessimism side also, where people have committed suicide, they could not repay the loan. Then the other side is, there are a lot of training programs, there are a lot of YouTube videos, and there are plenty of information, right? So obviously, as you know that, okay, wherever there is a large participation, wherever there is a demand, there will be a supply. As simple as that, right? That's the basics of economics 101, right? So obviously, and people like you and me are looking to engage in markets for whatever reason, and we are looking out for source, we're looking out for information who can help us, correct? So now, obviously, there will be a supply where people will come and teach you whether you don't like it or not, and then some teachings and all that they will charge money, which is nothing wrong in that. Okay? So anyway, let's not get into that. So what is the excitement about the market? So the simple reason is that, okay, I mean, any one of us, right, have some money. So you want that money to grow. As simple as that, right? So, so the traditional methods, people used to go to bank, put in savings bank, or some people convert that savings bank money to fixed deposits. And now post office, there are several type of instruments. Even those who are slightly savvy, right, they'll look out for some bonds. Correct. So any of this instrument you look, right, which is typically known as the kind of money market debt instruments, right, or rather debt instruments, it will have interest rate somewhere between 3-4%, like savings bank. Even there were time there it came down to 2.72% also, right? And the maximum side it might go to 9, 10, 8, that kind of thing. Obviously, there was a time the FD interest rates were more than 10, but that's highly inflationary environment. Now, when you talk about the market, you will hear the story. Some people will tell you that, okay, I'm making 3% a day. Some people will tell you that, okay, I'm making 5 lakhs, 10 lakhs out of 10 lakhs rupees of capital, right? So all sort of stories. So it just gives you that, okay, by putting 1 lakh rupees into fixed deposit, if you're making 7,000 or 8,000 rupees a year or 6,000 rupees, right? Here, possibly, you can make 5 times, 10 times, and that's what attracts. So there's nothing wrong, right? So I mean, to getting attracted to a place, where you can make more money, and money obviously has different reasons in life. We don't want to talk about that. I mean, money, as you simply, if you have money, you can do many more things probably. So in all this hyperbole, right? In all this kind of discussions, the basic nature of the what you call the marketplace is ignored. Right? So you see, in essence, we need to know that, okay, what is stock market and why does it exist, right? And maybe has it been always like that? Right? So now you think about it, right? Now we're thinking that, okay, people are making so much money from the market and all that. So maybe it's a thing, which has come up recently, right? So last 10, no, answer is no. So Bombay Stock Exchange, you can go and Google. Probably it exists from 1800 some years, right? Then National Stock Exchange came in 90s. So even if you take National Stock Exchange, fairly new, right? It's still more than 30 years, right? And on top of that, you have this foreign exchange like New York Stock Exchange, Nasdaq, and all. I mean, New York Stock Exchange, the Holland Stock Exchange, Amsterdam. They have been there for hundreds of years. So this is nothing new. So why did it came into place? Obviously, its genesis is. I mean, see, till the humanity survives, right? Even including if you go to the Mauryan dynasty, right, or even the kings and the sultans rule or the British rule and all that, you need a marketplace where you can buy and sell. So even if you go there to buy vegetables, right, you need to go to a market. So whether that market is physically present when you walk into a store and buy it, or you push a button somewhere on the computer screen, through some e-commerce websites like Amazon, Flipkart, or whatever the other things are, right? The point is that okay, there is a seller. Either he is physically present and there's a buyer. Either you are physically present or virtually, both way, right? So what is this e-commerce place are doing is they're giving you a platform to exchange, right? I mean, to contact a relationship between a buyer and seller. So why you are buying? So basically, you're buying a product or a services because you need it. See, if you are paying some money to say, some of these telecommunication providers like Jio, Airtel, or whatever you're using, right? Because you need to communicate with somebody, you need to use internet. So you're paying money. You're not doing free, right? So similarly, okay. Now think about it. When you buy a stock in the market, right? So that is available. Why the stock is available in the market will come. So you're paying money to buy, right? So here, what is that rewards you are getting? In case of when you're buying vegetables, obviously you need some as a food item, as a lunch or dinner, right? Now, if you're buying, as I said, fiber services or mobile services, you need to communicate. You have a need for internet, right? So when you buy a stock, what is the need, right? So you will realize the only need when you buy a stock as an individual stockholder. That's what we do, is to make more money. As simple as that. Right. now now think about it. Why, how can you make more money, right, if buying a stock? So it's simple. Your selling price has to be higher than the buying price. So it doesn't matter whatever you price you're buying. So if you say company XYG, right, you pay 100 rupees per share. Okay? So if you sell it for 105, 110, you make. As simple. So if you can't sell that, or if you don't sell that, above 100 and you sell below 100, then you lose money. It's very simple. So now remember this, your selling price has to be higher than the buying price. So now if you sell first, buy later, it's called short selling. Short selling is another different animal. It's quite restrictive trade practices. It's not easy. You got to borrow the stocks and then sort of cover it up. So let's not go into that direction for now. Now, basically, we're talking about we buy first and sell later. Right? So, but in this, I mean, we want to do that. But let's understand that okay, when you buy a company X, why not? Why is that stock exist in the market, right? So, what is that actually? You log into a broker account, right? So, Jiroda, Upstocks, Grow, any name you pick. So you go log in, your user ID, password, some second tier of authentication. You go and type the stock name, then you put say the 100 rupees, sorry, 100 numbers, 10 numbers, whatever, right? And then you put a market price or put a limit price and you buy. It's available, right? So it's basically that that listing is available in the stock exchange. You are getting a front end phase to buy or sell, right? So the question is that okay, the basic question is why does that company X exist in National Stock Exchange or Bombay Stock Exchange, right? The answer goes back to the legal entity structuring. So what is the legal entity structure? Legal entities are, how do you want to call yourself, right? Suppose for example, you want to run a business individually without having what you called any participants in your business. You will be called as a sole proprietor, somebody who is your only proprietor, right? So now there are two or more people they engage. I think up to 20. Then it's called partnership. Right? So now, if it goes beyond 20 and but below 50, then we come to the company structure. Say like private limited. Above 50 is private limited. So basically, you will realize every illegal entity that is available in stock exchange is a joint stock company, meaning they are all public limited company. Okay, so you won't find partnership, private limited, or sole proprietors, in the stock exchange. So why do these people, come to the stock market? It's simple. They need money. See, you have either an existing business or you are setting up a new business. You need capital, right? So you need capital to buy your assets, to buy your raw materials, to process the products or services, whatever you want, and then sell them and make money out of it. That's simple thing. So now, if you need money to process or to purchase assets, you need capital. I mean, the money is basically either you get it from bank, but now if your credit evaluations, a bank is not giving you that amount of money for whatever reason, then you come to the public saying that this is what my plans are. Okay, this is what I'm going to do. This is my business model, and now this is the capital I'm looking at. So if you be a part of this capital, suppose for if I need 1,000 rupees capital and I divided that into 1,000 units, each and every units will be called as a single share, right? So you can buy one share for 1 rupees, right, and be part of the story. The person who has floated this idea, who has created this company, are normally called as promoters, and those people who participate in this capital sourcing exercise are shareholders, right? So now question is that, okay, if they are taking capital, they must promise something in return, right? So it is obviously, if you look for a guarantee, there is nothing called guarantee in the stock market. But the whole idea of participating in a stock market is that I have a desire to earn more than what I could have got in fixed deposits or some other instruments where I don't want to do anything. So imagine, if you want to invest in fixed deposit, what do you do, right? You just click a button in some banking portal, and the fixed deposit is open. You are not doing anything. No selecting stocks, nothing, right? Maybe maximum you can select the period. So in return, you get 6%, 7% interest, right? So now here, there is always, that's expectation that okay, we should make more than the 7%. Right? So look at the dichotomy here now. The whole instrument is designed, to give some alpha. Alpha means the incremental here, the incremental return over the fixed deposit, right? Meaning anything higher than what we get from fixed deposit, which is roughly, 6, 7, 8%. That's the range, right? So why we expect 10% in a month? Even some people are doing saying that we're doing 10% in a day also, right? Well, it's greed, right? So I said, I mean, you see, somebody says that okay, I'm going to give you 1%, 2% return every day. Are you going to say no? No. You'll say okay, fantastic, I'll get this return soon. But now think about it. The person who promotes the company, and he is the largest shareholder. That's what most of these joint stock companies are. So you will realize, there is a promoter holding, which is roughly in India, somewhere around 60% plus on an average, particularly the small cap and the mid cap companies. Now, they why they are putting money into the business rather than they can come to stock market and make 1%, 2% per every day, right? Well, so these are some basic tenets. There is a business which is available for sale partial, okay, at a price, okay, and that business has the ability to make some profit. So technically speaking, your share of profit is the percentage of the shareholding what you own. Okay, that's how it is. Okay, but obviously that okay, assume that you own 1% of that company, and the profit turns out to be 1 lakh rupees, right? So ideally your share should be 1,000 rupees. But the decision making to distribute that 1,000 rupees to where to spend, either to give it to the shareholder or to keep that money in the business, is decided by the promoters because they are the one who manage the company either by themselves or through a board of directors. Okay, see, there will be always a board of directors. So in some companies, you will find the promoters are the significant portion of the board of director. Sometimes, they just play second fiddle, sit back and give it to the professional, employees to manage the company, right? So that's how it works. So it's not entirely, up to you, being a minority shareholder, to demand the way you want. Okay? You can have complaint and all that, but that's the ground reality. So now we must understand that, okay, if we are buying a company A, B, C, D, E, F, Y, whatever, right? It is a business which is available for sale or resale. Okay, what is sale? Sale is the first time, when they come to the stock exchange, what is called also primary offering, right? So first time they come, they ask that, okay, this is the capital we want, and then you apply for it, and you get some shares, and you become part of it. So after it get listed on an on and frequent basis, it is available for sale at certain prices. So that price is determined at the stock exchange. So every day you open the market, or you open the demat account, starting from 9:15 till 2:30, right? There will be prices going up and down, up and down, up and down. So you buy it one share, you pay that as the price. So if you calculate that share into all the shares that company has, that becomes the value of the company, which is otherwise called also market capitalization, right? So now, if you are buying, someone is selling, otherwise you won't get, right? So what is your understanding of the valuation of that company might be totally different from the person who is selling. This is a classic case. Okay. But before that, let's understand. Now these people who are the promoters, who are sorry, general of the company, they took the money, they got back to the business. They are not in the business of buying and selling their own shares every day. Say, any Tata companies, right? Tata Motors, Tata TCS, or Tata Elix, anything you pick it up. So they don't come and buy those shares on it. So they have a holding, they just sit there and run the business. Right? So now the question is that, okay, when it comes to stock exchange, who are these people buying daily and selling daily, right? To understand this, okay, let's go back, how the structure is designed for for an investor. Okay, so you have, for example, like, okay, company has 1,000 shares. Each and every share is, broken into 1,111 unit. Correct. So now there will be 1,000 shares. So they will bucket the 1,000 shares into 10 portfolios, or 10 folios, what they call it. A will have 1 to 100, B will have 101 to 200, C will have 201 to 300, right? So now I'm just simplifying it, but these each and every share will have a unique number. That electronic recording of these numbers is typically called as dematerialization. Okay. So when you deal with a CDSL note, what you are getting, or an NSDL note you are getting, it's the depository which decides the ownership. Depository is actually dematerialization. So whenever we say, have you opened a demat account? It is not exactly a trading account. Of course, these accounts are ideally, you would have heard of the term called 3-in-1 account, right? Or 2-in-1 account. So this is exactly dematerialization of the shares, the recording of the shareholders' numbers in electronic format. See, previously, during the days of those manual activities, right, there used to be share transfer certificates. Share certificates there used to be there. If you buy a share, then the owner, the buyer has to sign, the seller has to sign. There will be a stamp, and then you become the share. Those things has gone into the digital mode. Correct. So now, if those promoters are not buying and selling, then who is involved? Obviously, anybody else, who want to be part of the market. That's will be the ideal answer, right? But the technical answer is slightly different. Okay, so the bankers, right, or what you called the custodian, the treasury of the money, right? They do have different functions. See, we use the banking as a retail banking, where we go deposit the money, withdraw the money, transfer the money, what we were doing. Right? Similarly, the second side of the banking is, where they loan that money and make some money out of that, right? Which is typically called as net interest income, right? They do have also investment banking activities. So investment banking is typically, one section of the investment banking is the capital market operations. So they have a responsibility which is given by the government through the regulators. So who's the regulator here? Largely Security Exchange Board of India, or otherwise called as SEBI. Of course, NSE also has regulations, National Stock Exchange or Bombay Stock Exchange, right? So these regulators make sure that okay, the bankers are also market makers, meaning they have to maintain the liquidity, right? They have to see the right rate of a right kind of order flow is going around in the market. Also, bank plays a major activity through some other name. There are other players also involved, like this mutual funds, right? It's a pool of money. You call it mutual fund, you call bank as investing into the market, insurance companies are investing into the market. Is nothing but the public money is accumulated or the pool and been put into the market, right? And now these are organized pulling of the money and all that. Then come we are the shareholders, right? There might be some big buyers, big sellers, small buyers, small sellers. We are all little participants. But you'll realize both the case. Either you are a big buyer, big seller like financial institution, banks, insurance and all, or the smaller or a big investors, right? We have nothing to do with what promoter is doing. Okay. So there is a complete detachment of the participant. I'm not saying the relationship. The people who participate in managing, running the company are totally different than the people who are buying and selling in stock market. This is a very, very important point to know. Okay. So now, whenever we buy and say, then suddenly, the company news are coming and all that, we assume that, okay, that's how the stock price would react. And so maybe you say, no. Now you know why. Suppose the company is declared, say 20 rupees dividend. Okay, it comes to say, the stock price is around 100 rupees and you are declaring at 20 rupees, 20% dividend, three times more than the fixed deposit rate. So you would expect that, okay, probably the next day the market will jump. And suddenly the price doesn't jump. Then you get surprised at why it's not jumping. Well, the simple reason is this information might be known to some other people or they might have anticipated in advance and they have already paid the price. So, in short, the price you see on screen, which is available through your demat account or trading account, might be discounting a lot of information which are getting published. That is why it is called discounted place. So, stock market is a place where it determines the price for future, not for present. Now, when you determine a price for the future, there has to be inefficiency. Some people will do it wrongly, some people will do it some extent accuracy. Nobody can be perfect, right? So more the model you have for anticipating a price appreciation or a business appreciation, higher the chances of you making money. Okay, that is one part. The second part is because there are thousands and millions of people who are buying and selling in market every day. They are humans. So somebody who is punching the order, right, in a trading account, behind the desk is a human, right? And humans are susceptible. They are exposed to emotions. So maybe sometimes we'll talk about the behavioral biases and the human psychology, how it impacts our decision making, particularly in regards to market. Right? We don't care about what those psychologists are doing outside the market. That's not our job here. So this human psychology or the biases or the prejudices, right, tends to make the price irrational. Okay, meaning it might run ahead, well ahead of what the future can be, or it might go down more than what the future predicts. So this offers you to, it offers you to rotate the money, okay, and it offers you to take the opportunity also to make an entry. Okay, let me make it clear. So this irrational price movement in the market for a particular script, okay, or a particular script when it's in a stock name, okay, offers you to time the market, okay, and make some money out of it. Meaning, you buy, sell, and then come enter again, buy, sell, right? Or I won't say or, and I come at those irrational times which I feel either it is too high or too sell, and they take advantage of the situation and wait for the right opportune moment. Okay, so you will realize two elements, to it. So exactly when you rotate the money, time the market, these are typically what we call trading. Okay, trading is utilizing that inventory, right, to make money on a rotating way or in and out again, right? So people say that okay, trading is short term, trading is investing is long term, and nothing like that. Okay, so trading, again, what is short term and what is long term depends on person to person, right? See, some people who hold stocks for 1.5 years, right, and then they sell. To some people, it might sound like a trading, but the person who is holding and selling, he will call it as a positional trading, right? Now, if you go by the Indian income tax definition, anything, any share you hold over a year is basically a long-term capital gain. So, if you want to go by that definition, then ideally anything you hold more than a year is long-term. Anything you hold less than a year is short-term. But I don't think this definition is more from a tax perspective. The real participants will never accept that. Right? So let's not get into what is investing is long-term, trading is short-term, nothing like that. Okay. So it all depends, what advantage you can take of this irrationalities. If you can take out of it, it is fine. So how we are going to take out of it, right? And what are the tools available? We'll talk in detail probably the next time. But like I just said that okay, anything has to when you start something in your life, right? There has to be some referential sources. I mean, somewhere you have to read. See, the world is full of practitioners. What is practitioner? Somebody who has done this before, right? So now there are a lot of people who have invested in the market. They have made billions. They have lost billions, and so right. So not necessarily everybody has written. I mean, how do you communicate your story to somebody else, right? Either you write a book, or you do podcast, or you do training, or whatever, right? So that is where the Indian scenario becomes very complex. So if you look at any books recommendation, right, pretty much you will surprise that okay, why all these books are coming from America. That's because some lot of practitioners in America. That means the people who has made money, right? They have taken the pain to write this, their experience, their methodology, okay, to communicate to the people that this is what we did. Unfortunately, in India, right, there are very few public materials available, from the highly successful people that we know. See, for example, like the great late Rakesh Jhunjhunwala ji, right? Or even Radhakishan Damani ji has written very few. Or even you take this contemporary, investors like Mahavir Mukulji Agrawal, right? Or Asis Kacholia ji, right? They have very little, what you call public discourse, so that we learn. There are few books and all that, right? But so what is the choice left out for us? Unfortunately, we have to read, which are time tested, which have influenced people, and then read them again and again. Try to make a sense out of it in the Indian market, which is a practical experience or otherwise called as philosophy. So now, often you'll be asked that okay, what are the best books suitable for me, right? So this is I mean, what are the top five books, the top three books I should read, before I start the stock market? Unfortunately, there is no base three or five books. Okay, this is a case of experimentation. It's like a trial and error. So what, as usual in a trial and error, what you do is you go to the best available resources, you read it, and then come and try that experiment in the Indian stock market. Then you realize that okay, this is not applicable for me, right? And then you go to something else. Or similarly, that okay, then you start reading, say for example, all fundamental analysis and all that, right? Then you realize that okay, this is not something which is giving me money. I may be good at technical studies, and then you start scratching the technical books, right? So let that be evolution process. You don't force it saying that okay, I need a list of 50 books and then I'll start reading one by one. That's not what happens. Okay. So, I mean, I have thought about it a lot. Okay, so if you ask a person, who has been in market more than 20 years, 25 years, 30 years, and all that, right? You will realize they have read a lot of books, articles. Okay, that's the very, very common features, among all this. Simple reason is because you have to keep updated. Okay, so either you get that information source from newspaper, television, or from the books. Well, you need to get updated. Okay, so that's the whole idea. So I have put up a list in my suggestions. The two or three books. I won't go more. Okay, so let's talk about fundamental analysis. So there are many books, but I'll go with the simple one, which everybody will talk about. It is the Intelligent Investor, written by the Benjamin Graham. Though it is but a boring book, initially it might sound okay. You may not find the usefulness over a period of time where you want to amend the concepts. But saying that, there is a very old proverb. To break the traffic rules, you need to know the traffic rules first. So I'd suggest that you read that. It will talk you about, what are the basics of investment, what are the basics of financials and all. So in the fundamental category, I would like to add another different perspective, because this is what I was not exposed to. I started with so-called value investing, right? And then only to realize after a few years that okay, there's something called growth investing. So that's why I'm suggesting, you pick up one from value investing, like I said, Intelligent Investor by Benjamin Graham. The second from growth investing is a seminal book. Okay, they do have a tool also in India, which is called How to Make Money in Stocks by William O'Neill. Okay, How to Make Money in Stocks by William O'Neill. They have a tool in India called MarketSmith India. MarketSmith India. You can go and search. Uh, and now these two books, how to read them. As usual, it's like reading an academic book. You sit down, you take a piece of paper, open a Word file, write down one by one, clarify your doubts, in Google. That's how things works. Okay. So now I would add a third book. Okay. So that is called Stock Market Widgets. So this is written by Jack Swagger. Jack Swagger, Stock Market Widgets. Now there are five series of five books from this author. So what is this market widgets? Mr. Jack Swagger identified the person there. Okay? So Jack Swagger identified that okay, some of the best traders, well-known traders and investors of the world, he went and interviewed in a very legitimate manner. He asked questions right from their personal life to their investing style to their psychological stuff, right? And he has put it in the questionnaire format. Okay, so first book came I think during 80s. The last book came unknown market widgets. So in my opinion, because the span of the books started from 85, 86 to 2018, 19, it's quite a long period. I would say first start with unknown market widgets by Jack D. Swagger. Okay, these three books should be good enough. Obviously, what is the area of circle of competence, meaning, what are the area of studies you should be doing, uh, how to build that circle of competence. We have tons to talk about it, right? So maybe with due time we'll talk about it. For now, this is I just left you with three books. You read about it. You let me know any questions. I put the email ID. So I was put the comments on also. So let me know if any questions, any comments, any improvement suggestions. I'll try to do. Okay, and as a parting statement for today, well, I have no commercial association with anyone when it comes to market. I have been, in corporate jobs. I've been myself as an investor for more than 30 years. It's actually 35 years. I was a teenager, when I started. So I've been to rough cycles, and, down cycles, off cycles, and all that. Not a, some flashy, judgy, successful person, which probably you might have seen in the television or the newspaper. I'm just a simple, a neighborhood guy like you. But I left my job 8, 9 years back. So roughly, I can give you a confidence that okay, you can run a family, you can run your finances exclusively from the market. Of course, my experience, my mistakes that has helped me a lot. So that's how I am. I said, let's not get into my personal side too much. It's not going to help. Okay. So let me see, how much. Okay. By saying that, we do have a couple of interaction groups where every Wednesday, Friday, we keep meeting each other through what is that, MS Team, Microsoft Team, and Zoom calls. In case you are interested, let me know. I will forward your request to the guy who is managing. That's how it is. And this is just a beginning. I'm sure that, okay, honestly speaking, I've not structured this calls or anything. As I said, mention it very clearly. I've been doing this for long. I have a bit of spare time, so I'm using it. I know that, okay, these things can be structured. These things can be presented in a much better manner. But I'm sorry. For now, I don't have that, bandwidth to do it. Definitely, in future, I'll try to do. With that, thank you so much. Have a nice day and let me know any questions. Bye bye.